tax and investment planning together. Visit alphawealthgroup.com for a free report.
Now, from the Signature Bank Studios, this is Chicago's Morning Answer with Dan Proft on AM 560. The Answer.
Top of the morning, Dan Proft here. And just a quick point of order per our conversation the last hour with Rich Lowry, as well as review of Operation Catch of the Day going on in Maine and the basis for it. We had Gregory Bavino, the demonized ICE commander on the program, back, what's today, Tuesday? And I posted the interview that we did with Bavino on X, at Dan Proft is my X handle, if you want to listen to it, because we really got into it in terms of depth with respect to what transpired during Operation Midway Blitz, including the 2 ICE-involved shootings, the caricatures of him and ICE officers by BJ and JB, as well as the assertions made by the Abolish ICE, Open Borders crowd versus the reality of ICE operations. So it's pretty good drill down we got from Bavino. So I wanted to direct people's attention to that. Returning to Davos, President Trump wasn't the only person there with some important things to say. Former Chicagoan Ken Griffin, he of Citadel Capital, now Miami resident, was there, a panel discussion about global economics, of course. And he had a couple of interesting things to say, both about the previous administration, that would be the big guy, as well as a general comment about the reckless, in terms of what is the most reckless policy of our era at the nation-state level. Both are worth checking out. Here's the Biden versus Trump from Ken Griffin.
You cannot imagine how painful it was each and every day under the Biden administration to look at what new crazy proposal was being put into place to solve a problem that didn't even exist. I mean, our constant friction at Citadel with the government across umpteen different aspects of our business was exhausting. And to have that literally end on one day, Election Day, just gives you so much energy as an entrepreneur to go back and build your damn business. So the biggest sea change I've seen across American executives has been just like the giant sigh of relief. I can now go and focus on building my business. And that prior administration, we happen to be a creditor of Spirit. Their merger with JetBlue was stopped. Spirit's in bankruptcy today. There were so many decisions that were so poorly thought out in terms of economic consequences. It cost the U.S. economy dearly. I cannot emphasize that enough. And so the Trump administration is making slow progress on deregulation thus far, but the end of the regulatory onslaught has been just an extraordinary boom for American business.
Getting government out of the way. That in itself is a sea change. Very interesting comments from Griffin. His now more general comment about the Western world and the recklessness of our age.
The area of recklessness is the spending of governments around the world, who are all, with little exception, all spending well beyond their means. That's the recklessness of this moment in history. This is not a parallel to the 1920s in terms of the recklessness of the private capital markets. It's a story of the recklessness of government spending. Within the private sector, there's a huge question as to where AI will take us. And I was carefully taking notes and listening to what Larry has to say, or to what Madame Lagarde has to say, because this is one of the big issues of our moment. Will AI create the productivity acceleration that is honestly that's hoped for in Washington and in the halls of government around the world as a way to overcome the profligate spending that we're currently engaged in. Like the world needs a savior. And the hope is that AI is the savior that we need for productivity. And the challenge with this is it may or may not be. We just don't know yet.
I wouldn't pay too much attention to what central bankers like Christine Lagarde have to say, European Central Bank. And you have to pay attention to Larry Fink at BlackRock, but it's a struggle, too, because he's such an obnoxious DEI-addled individual. But anyway, I digress. For more on the topic, pleased to be joined by Jim Iuorio, host of the Futures Edge podcast, special contributor to WirePoints, wirepoints.org, all things Illinois policy related. Jim, thanks for being with us.
Thank you for having me, Dan.
So, Ken Griffin, first, in terms of the sea change from Biden to Trump, even if the additional deregulation is marginal at this point, just the sort of stopping the regulatory onslaught so people like Ken Griffin can continue to build their businesses. I mean, that in part explains the surprise, quote unquote, surprising to some GDP growth in the last couple of quarters, doesn't it?
Well, it does. I think there's a couple other things that go into the surprise GDP growth, too. But onto the deregulation part, or having someone in office, an administration that business people feel has their back. And you can see that in the small business optimism numbers that come out once a month. And the moment Donald Trump won the election, it had the biggest single month jump ever in small business optimism. And optimism isn't just a wonderful emotion. It means people spending and expanding and thinking, okay, the cuffs are finally going to be coming off, and perhaps we can make some money. And it's a big deal. And again, Ken Griffin said something else that I disagree with. He said all the policies over the Biden administration like they were meant to do well but poorly constructed. When every policy seems so economically destructive, I can't see how someone would argue, unless they're being kind, that they were actually meant to do well. It always reminds me of the Thomas Sowell quote, where he says the history of the last 60 years is we replace things that work with things that sound good. And you can always say, well, like things like minimum wage going to $15 in the Chicago area and Cook County. Like you say, well, don't you want people to make more money? Yeah, but then look at the downstream second and third derivatives of that and people losing their jobs. And every one of these policies was constructed that way. It was a depressing time. In fact, and the one thing I love that he pointed out is that the deregulation efforts are admirable and good, but they need to accelerate quickly. Look at the housing market. We have shortages in housing, not because there's no money in building the 3-bedroom, 2-bath home, because the first $80,000 of it in near any blue areas is covered up in regulation. But anyway, I digress.
Yeah, no, I mean, I think that's a good point. And I agree with you. We ascribe good intentions to people that don't have them. I suppose Ken Griffin was probably just trying to be generous, and because intentions don't matter, outcomes do. And so, yeah, I mean, all your good intentions or your malintentions, the consequences that were visited upon the American people, that's the point. The recklessness of actually, before we get to that, I mean, it's sort of implicit in our conversation, the recklessness of the spending. The spending is to prop up agencies and initiate programs that make the government that much more sclerotic and susceptible to fraud and unleash more cadres of minders and regulators. So, I mean, they go hand in glove there. On the housing piece, Trump talked about that in Davos. I want to get your reaction. I know you knew this was coming, and it came.
Home ownership has always been a symbol of health and vigor of American society, but that goal fell out of reach for millions and millions of people in the Biden era because interest rates went up so high. Today, I'm taking action to bring back this bedrock of the American dream. In recent years, Wall Street giants and institutional investment firms, many of you are here, many of you are good friends of mine, many of you are supporters. Sorry to do this, Joe, I'm so sorry. But you've driven up housing prices by purchasing hundreds of thousands of single-family homes, and it's been a great investment for them. Often as much as 10% of houses on the market You know, the crazy thing is a person can't get depreciation on a house, but when a corporation buys it, they get depreciation. Okay, that's something we're going to have to think about, too. I don't know if too many people think about that. You buy a corporation, they buy 500 houses. They buy hundreds of thousands. They buy 500 houses. They can take depreciation. A person sweats and works and buys one house, they can't. But homes are built for people, not for corporations, and America will not become a nation of renters. We're not going to do that. That's why I have signed an executive order banning large institutional investors from buying single-family homes. It's just not fair to the public. They're not able to buy a house. And I'm calling on Congress to pass that ban into permanent law, and I think they will.
What do you think about his populist proclivities there, Jim?
I don't love it. I like it in some ways, but I don't love it. I think a much better angle would have been just to level the playing field. He's absolutely right. James Fishbeck, he was running for governor in Florida, was on our show, Futures Edge, a bit ago, talking about in detail the tax treatment differences, even the lending availability to the big corporations against the mom and pops, and they have a significant advantage. I think you just get rid of that advantage and let the market solve it. But I think his step is a good one. There's other things he's done which I don't like. He's encouraged the Fed to buy mortgage backs again. He's trying to, in some way, inorganically lower interest rates, and I think that's a demand-side solution to a supply-side problem. The reality of it is that there just isn't as much supply in the housing market. But one other thing to point out, too, is that back in 2021, mortgage rates went from about 2.8% to 7.5% in 10 months' time. That's never happened before, and that's going to be taught in economics classes for 100 years as to what the net result was. Anyone who owns a home who is planning on selling it and had their 3%, 2.8% mortgage,
locked in.
Like, no, I can't afford it. I can't get out of this. So it locked up supply, which I thought was fascinating.
Oh, there's no question. There's no question. Any place where you saw a run-up, and there were many enclaves, people like, yeah, I mean, it's great. My home increased in value during COVID, say, by 50%, by 100%, maybe more in some places. But then what do I do if I sell? Where do I go?
Yeah, and get your nice new 7.5% mortgage.
And on top of it. Yeah, right. No, I mean, there's no question about that. Where is your head with respect to this year and the market? I mean, I'm asking all of the soothsayers when it comes to financial markets we bring on the show about those individuals like Michael Burry, and it speaks to something that Ken Griffin said about AI being our savior. But people like Michael Burry, Big Short guy, and other wealth managers I know that are shorting the market, that think there's going to be some washout with overvalued AI companies that are not going to be able to continue raising capital and giving away their service for free. And we're not really sure what the market will sustain in terms of subscriptions and subscription pricing. And you're going to see a coming off of the Magnificent Seven and AI-related stocks, and by extension, NVIDIA and so forth. Anything that's AI-related, you're going to see a coming off there because it's going. There's just going to start. You're going to start seeing separation between those that are going to make it and those that are not.
So I think we've already begun to see a pretty healthy rotation. Like about 6 months ago, I said I thought the Mag 7 stocks would have a 30% correction sometime in the next 15 months. Now, NVIDIA sold off 20%, and the market basically just yawned. The NASDAQ itself hasn't made new highs since mid-November, while the Russell and S&P has. So this is a broadening out of the trade. Now, you look at like silver and copper and platinum and palladium, that's part of the AI trade. It broadened from NVIDIA, from the people making the AI, to people who are going to use it and the energy that needs to be produced to support it. So that's one of the reasons that those metals have gone through the roof. There's plenty of other reasons, too, but it's one of the reasons. So I actually think what's happened already, look, if the only argument you can make for a stock market going lower is that it's stretched, valuations are stretched, it's a relatively weak argument, because economically, I think, and again, the economy and the stock market are not the same thing, but they're definitely cousins. I think the economy, through deregulation, through the new tax structure for 2026, and the fact that people are reshoring investment here. And if Donald Trump says it's $21 trillion, and we all know he could be sometimes the exaggerator in chief, if the real number is $10 trillion in investment coming back in the next couple of years, this is a pretty good tailwind for the economy. I do think in the first couple months of this year, the stock market's a little bit vulnerable only because of the stretch valuations, but that's far, far different from just everything being so ridiculously overpriced that we have to correct 50% a la 2008.
Just speaking of precious metals, and let me fold in crypto because Trump made particular mention of crypto as well, something that he and the family are interested in, to say the least.
To unleash innovation in savings and financing, I'm also working to ensure America remains the crypto capital of the world. And to that end, last year I signed the landmark Genius Act into law. Now Congress is working very hard on crypto market structure legislation, Bitcoin, all of them, which I hope to sign very soon, unlocking new pathways for Americans to reach financial freedom.
Is crypto, is there enthusiasm for crypto being tamped down as you see precious metals spiking, and that's going to be the inflation hedge, not crypto?
Well, there's no question that that's the thesis right now. I mean, we've seen just unbelievable runs in the metals market and not so much in Bitcoin. And you can make the argument that Bitcoin is fickle sometimes, and Bitcoin still trades as a risk asset often. We just talked about the fact that the Nasdaq hasn't made new highs since November. Bitcoin still trades very much correlated to the Nasdaq, so it hasn't achieved its final form where it's going to be what they want it to be, which is a hedge against poor stewardship of fiat currencies. Which, again, you say that, then I'm on board, and it is in my stupid stewardship portfolio, which is gold, silver, copper, Bitcoin, real estate, things that will do well when we have a government that spends too much money. And we, by the way, something that Ken Griffin said about debt and spending, we are seeing Japan potentially have this kind of cataclysmic bond and currency event in real time. And all we do is look at it and don't learn the lessons from it. It's kind of disheartening because I think we should really take this as a really a teaching moment. And hopefully we'll get our spending under control as well here.
Jim Iuorio, host of the Futures Edge podcast, special contributor to WirePoints, wirepoints.org. Jim, thank you as always.
Thanks for having me, Dan.
And Jim joined us on Chicago's Morning Answer.
There's only one radio show in Chicago talking about today's biggest stories and telling you what they really mean. That show is this one, Chicago's Morning Answer on AM 560, The Answer.
Golfers, the Tinley Park Golf Show's coming January 30th through February 1st to the Tinley Park Convention Center. This isn't just another expo. It's 3 days packed with everything you